Hello, and welcome to today's webinar, Indexing Factor Premia, designed for power and performance, hosted by Index One in collaboration with BX, Financial Trust, and Phaseinvest. I'm Gayatri from Index One, your host for today. We're thrilled to introduce our speakers, Alexander Berg, founder and CEO of Index One, Chris McHeffey, president of BX Partners, Arno, chief investment officer of Financial Trust, and Arun Soni, co-founder of Phaseinvest. In today's session, we will explore how factor indices are constructed to capture growth opportunities by examining key factors such as value, momentum, quality, size, and low volatility, and their impact on enhancing risk-adjusted returns. We will also discuss best practices in factor index construction, focusing on methodologies that optimize performance. Factor indices enable investors to capture excess returns by targeting stocks with specific favorable characteristics. Grounded in empirical evidence, these indices are designed to be diverse, transparent, and straightforward. We'll have time for questions after the presentation, so please submit your questions in the chat box as they come up. Now, without further delay, let's dive in. Chris, could you kick things off by outlining some key factors in constructing a factor index?
Yeah, thanks, G. At BX, when we were assembling our collection of indices that we wanted to bring to advisors to help their clients, we knew we wanted to include a suite of factor-driven indices. We know that there's a tremendous amount of validity to the concept that factors can help drive returns over time, even though no factor is going to be in vogue at all times. There are over cycles factors that have been proven to help deliver better performance. There's been so much academic work done on the topic that there should be no such thing as insomnia. The funny thing is that the two index creator guests that we have on have read that academic work and have harnessed it. What we also know is that the best way to get exposure to various factors is not to simply go out and buy the ETF that theoretically is exposed to those factors, because there are tremendous flaws in some of those methodologies, right? So what we wanted to do when we interviewed our hundreds of potential index creators was help find an edge. And the edge in this case was finding ways to get better exposure to the factors themselves that you wanted to get exposure to without unintended exposure to other factors, which really tends to, kind of muck up the gears in some of these other kinds of strategies. The other thing that that Arun and Arno have both done is figured out ways to combine factors in ways that the factors are complementary to each other, and the factors themselves are not necessarily correlated, helping to drive better risk-adjusted returns. So we're really excited about the indexes that both of these gentlemen have created that reside on our platform. We have other factor-based strategies as well, but we wanted you to hear from Arno and Arun because we think that this is going to be a great exercise in thinking about how to apply factor-based investing to your clients for their. Let me hand it over to Arno to talk about financial harnessing.
Thank you. Well, a little bit about Financial Trust, and hello everybody. My name is Arno Mayer. I'm the Chief Investment Officer of Financial Trust Asset Management and the founder. The firm has a unique breadth of quantitative factor-based investment strategies that we run. We are also GIPS compliant. We've been running factor-based portfolios for both our existing direct clients and institutional clients since 2001. And I wanted to talk a little bit before we get into the details of our strategy and then some of the work we've done around factor analysis, a little bit about our investment philosophy. We really believe compelling investment results are really just can only be repeatable with a highly disciplined investment approach. So we're really focused on that, and that's why we've always ran factor-based portfolios for clients for many, many years. We also believe being transparent in our factor-based approach is paramount to winning trust with our clients and building confidence. Historically in the past, some quantitative managers have been criticized for the black box approach to quantitative management. We're not. We're more open in talking about the direct factors that we're using. And we really believe a disciplined, rule-based investment approach minimizes the emotional bias that's prevalent in all investors, including investment professionals' decision-making process. G, if you could turn the slide, please. So we run a lot of different investment strategies for our clients, and we have 5 of those different strategies available on the BX index. They focus all on different areas, and I'm going to be really brief in describing some of them because our real main focus is going to be on the value momentum leader strategy, or specifically the value and the momentum premia that exists. But our first 2 strategies, American leaders and international leaders, they focus on the size factor. American leaders is the top 25 largest stocks in the S&P 500, but we equally weight the positions as opposed to market cap weighting the positions. The international leaders is the 50 largest ADRs, or international stocks that trade on our exchanges, also equally weighted and rebalanced quarterly. So those are very more passive oriented approaches. Again, lower turnover. The next 2 are our American Discipline Mid Cap and our American Discipline Small Cap. They are our smart beta strategies. They are composed of 14 total factors in the construction of the portfolio. Those factors are broken into 3 groups: an earnings momentum model, a profitability and quality model, and a value momentum model, which we're going to get into in a little bit more detail. We pick stocks from the S&P 400 mid-cap index or the S&P 600 small cap index. And we once we do the ranking based on the 14 factors, we keep the sector weights the same as the market, but we equally weight the positions, and then we rebalance on a quarterly basis. And then lastly is our value momentum leaders methodology, which is really the foundation of numerous strategies that we run more on the active side. We run it with our value momentum leader strategy with you in a completely pure factor-based strategy, but is also the underlying model that we run with a number of active strategies that utilize additional resources like top-down analysis and technical analysis. But with BX, we wanted to have all just quantitative-based portfolios. G, if you can go to the next slide, please. So the value momentum leaders methodology starts first with a little bit of a screening process before we get to the factor ranking process. So we're investing only in U.S. companies. We have to have a market cap greater than $2 billion, so it can literally focus on all market cap segments. Next is the thing that we put together to ensure that we have lower valuation momentum stocks, and we basically want to have stocks with a price to sales ratio within the model that have at least a price to sales ratio of 10% lower than the average price to sales ratio of the S&P 500. Then next, quality factor, we only want companies that have higher year-over-year earnings. Once we have that general list of stocks, then we begin the factor ranking process. And the factor ranking process, as the name would suggest, value momentum, or again, we came up with our own word, which we trademarked, is combined of 2 factors, value and momentum. So first, I want to speak a little to the value factor that we utilize. We utilize low price to sales ratio. And as you all are aware, there are a multitude of other value metrics, price to book, price to earning, just to name a few. We utilize price to sales because it is the least easily manipulated with accounting practices. So we feel it's a pure form of value. Then next, we rank all the names based on price momentum over 2 different time periods. A lot of it is based on academic studies of what those two different time frames are. From there, we'll get the ranking and we'll buy the top 50 names with the best combination of value and momentum, which will then equally weight the portfolio, but will rebalance on a monthly basis. So a little bit with the market cap weighting of $2 billion or greater, while we can focus on large, mid, and small, historically, it's had all different sectors in it, but it's focused more on the mid to small cap sector within the market. And G, if you can go to the next slide. So let's talk a little bit about factors. And we're first going to talk about the value factor and different studies that have been done. And we've got the different links for you at the end of this reference that G could send you if you want to actually read the article. Some of them are pretty famous. They're both academic studies as well as studies done by people within the industry. Femme French is more an academic study. It's very, very famous. It talks about cross-section expected stock returns. And they found that value stocks tend to earn a return premium over time. So the question really becomes, why do value stocks earn a return premium over time? And there's two general explanations. One is a risk explanation. The risk premium is earned for investing in companies that have poor prospects and therefore have a low valuation ratio. So in other words, they're inexpensively priced for a reason. Their earnings prospects, maybe in the more recent period, have not been as positive as people would like. Next is the behavioral aspect. And it's really the result of mean revision of irrational market participants. You all have probably seen this many times. The stock comes out and has a short-term earnings miss, and the stock really gets pushed down dramatically. However, if earnings do continue to improve, at some point that really becomes a lot more of a value proposition for forward-going returns. So the value premium can be really explained by those two in general. Again, I would suggest for people that really want to get a lot deeper into it, where they talk about all the different factors, to read the French Femme study, which is very famous. G, if you could go to the next slide, please. Okay, next is the momentum premium. And here we have Jadish and Titman talking about returns to buying winners and selling losers, implications for stock market efficiency. Their general analysis came out that past winners have outperformed past losers over the following 12-month period. And what could be some of the rationale behind that? One might be initial underreaction to new news. Some new catalyst comes out and maybe the stock comes up somewhat, but people have an anchoring bias based on how they have viewed the company in the past, as well as conservatism bias. They don't think that it might not be the new information, might not be lasting into the future. Secondly, herding leading can lead to overreaction, which can eventually lead to long-term value mean revision, representative bias. So again, some of the new information can come out, stocks could come up dramatically, but then come back down a little bit in price, but the catalyst can lead to longer-term value over time. So the momentum premium is actually very strong, but like all factors, whether we're talking value, growth, momentum, size, quality, they're all going to have different periods where they outperform and they underperform. And we have to be aware of that. So if you could go to the next page, please. Okay, so next, why do we combine value and momentum together? And here's some studies more from industry participants, Arno and Moskowitz, showed that value and factors earn positive return premiums in various asset classes. This is a very important part. We're negatively correlated with each other, and that combining factors with negative correlation can help improve risk-adjusted returns, which we'll talk about here in a second. Additionally, momentum can help avoid value traps. So if you were just a strictly value buyer of stocks, the big problem that can come about with that is cheap stocks can stay cheap for extended periods of time. That's why they're called value traps. Momentum may help signal a presence of a catalyst. In other words, that value is starting to be recognized. So combining value and momentum can be very positive for the negative correlation aspect, but also for trying to see if value is finally starting to be recognized in the market. Now, that doesn't mean it can totally avoid value traps. I wish it would be that easy, but it definitely helps to minimize that. G, if you can go to the next page, please. Okay, so this is a study from the French FAMA data library, as well as AQR, which is an industry participant. It just showed different returns from 1957 to 2000 returns of 3 different main factors: momentum, quality, and value. And you can see the correlation analysis on the right-hand side, that we have negative correlation with those factors. So combining those factors together have been very positive for us. Obviously, we have the value momentum, the value built into the factor by trying to buy stocks with at least a 10% lower price ratios than the S&P 500. We have quality somewhat built in there with one factor, saying we want higher year-over-year earnings, and then we have momentum. So they've worked very good together in unison. But now here comes the $1 million next question, and it's about really factors that they go in and out of favor over time. So G, if you can click to the next slide. So this slide really talks, will these factors persist? And what I'm talking about specifically is value and growth. And this is an article from Beck and Hughes. Will your factor deliver? An examination of factor robustness and implementation costs. And they tested 6 different factors across different regions and different factor definitions to test for robustness. They tested low beta, size, value, momentum, illiquidity, and then liquidity, and then quality. And they found that value and momentum tended to be the two of the more robust strategies over time. So again, we like to utilize this within our portfolios. We've been doing it since 2001. Frankly, before a lot of these different articles came out, we had also read other additional research that was put together even before some of these articles that helped us drive our framework of trying to create a portfolio that combines value and momentum and tries to take some of the things that are prevalent in each of those individually, and by combining them, come out with a better type solution on a risk-adjusted basis. And G, if you can turn to the next page. Here are all the different articles that I mentioned and when they came out and where they were. Again, G can send this to you if you would like. And that's it. And now I'll hand it over to Arun.
Yeah, thank you, Arno. So our investment philosophy is very similar to Arno's. It's the discipline of rules-based, a systematic process, minimizes emotional and cognitive bias, and any kind of bias in any decision making is generally a negative, and transparency of the methodologies. One difference is that we seek to isolate each factor premia, so whether it's quality, momentum, value, low volatility, size, etc. And also we employ a proprietary model. It's a price regime identification model, and the underlying theory is that we believe that when capturing price analytics such as momentum or volatility, rather than measuring these attributes over the same time window for each stock, we have a model that seeks to identify breaks, structural breaks in the volatility regime of each stock. And then it signifies the period over which we should measure momentum and volatility. So we are constructing different time windows over which to measure momentum and volatility for each stock for each period in time. So because each stock is in its own unique price phase. And it leads to quicker detection of turning points, whether it's when the stock has peaked or when momentum has reached a trough. Of course, you'll never catch the exact peak and trough, but it's quite accurate in detecting it early enough. And another thing is that to measure a predefined period of time is a random construct, right? Why 12 months? Well, that was just happened to be a nice calendar year, but why not 11 months and 10 days? So that sort of is a parameter, and this approach removes one very important parameter in estimating the model. G, if you could go to the next slide, please. So our methodology for capturing factor premia is it begins with building an investment universe that's calibrated to the factor. So if it's dividend yield, then a investment universe that captures a dividend yield universe. If it's a general factor momentum, then it'll be based on, let's say, large caps, mid cap, small, mid, and so on. Then for each rebalancing period, we filter the investment universe by the factor we are trying to capture. So again, if it's momentum, then let's focus on the top 50% by momentum. If it's dividend yield, let's capture by dividend yield. And thereafter is an approach that's quite unique, we think, is what we do is we then believe that the information contained within the factor, like dividend yield, exhausted, because we've constructed the universe using dividend yield. We have now filtered the universe using dividend yield. And reusing dividend yield would just be using stale information. And also, as Arno mentioned, there are lots of valid studies that momentum works very well as an overlay onto other factors. So what we do is we then rank the filtered universe by risk-adjusted momentum from our phase detection engine model for doing the final selection. And then the weighting or the position sizing is also done using a smart beta function. It's a standard smart beta function, but the attribute that we use is the normalized exposure from the PDE model's momentum attribute. And this momentum overlay helps to identify the stocks that are also being rewarded by the market. And so it's momentum within the filtered universe. So the stocks that will come into a dividend yield index or portfolio will be very different from the stocks that will come into a momentum portfolio. So it's not to say that it's going to pick momentum stocks, it's going to pick the stocks that are in strong momentum within that filtered universe. And again, going back to what Arno said, in a more value type strategy, it helps detect value traps, and a dividend yield growth strategy is a special case of a value strategy. And it definitely helps in, you can't fully capture all value traps, but it does help mitigate the value traps to some extent. G, if you could go to the next slide, please. So we'll just use an example of a model that's basically, it's 3 different factor indices put together to form a model. And it also serves to illustrate our approach. So our approach is to isolate each factor, and then that allows the user or the advisor to combine the models as they deem fit. So for example, if you just wanted to generalize US portfolio, you could just take the US growth and a US income model, which is basically the momentum and the value model. But in this case, we've created a global model with 3 sleeves. One is a US growth, which is our US 10 stock momentum model, a US income, which is the dividend yield and growth 10 stock model, and the international, which in this case are all non-US domicile stocks that have either a full exchange listing in the US or an ADR on the major exchanges. And going back to what we discussed before, the first step is to construct an investment universe that's calibrated to each sleeve. So, for example, for the US growth, which is the momentum, we take the top 100 US stocks by market cap. In the income, we find there's 115 US securities that have grown dividends over the long term each year. And the international one is all the, as I said, the listings on major exchanges of non-US domicile stocks. There's about 325, 327 of those. And the second step is the filtration of the universe. So in the growth, we filter in stocks with a PDE momentum percentile of 60 or above. For the income, we filter in all stocks that have a dividend yield in the top 40 percentile of the universe. And again, for the international, it's the top 40 percentile by momentum. G, next slide, please. And then comes the portfolio construction. One important aspect in our construction method is that we actively control size exposure, because size is a very strong factor. And during market dislocations, when there is certain kind of external shocks, fear, etc., size begins to dominate. So what we want to do is not have a positive or negative contribution from size. So we seek to look at the investment universe and ensure that the overall portfolio has a size exposure that's equal to the sort of median value of the universe. So we divide the universe into 5 size buckets, and we ensure that the final stocks, there is a representation from each size bucket. And so basically we rank the filtered universe by the risk-adjusted momentum score from our model, and then pick the best 10 in each of these cases, but ensuring representation from each size bucket. And then, as you can see, we end up with 10 stocks in each. And if you look at the US growth and US income, even though momentum is an overlay in the US income, it produces 10 completely different stocks than the ones in the 10 growth portfolio, which is the purely momentum portfolio. And the 2 weighting columns are, the first column is the weight in the factor portfolio itself. And then the second column is its weight in the investment model that is built from combining these 3, and we call it the 10-10-10. And happy to answer questions on any detail of the PDE or any other construction method. Well, I hand over to Alexa. Oh, sorry, to Chris, sorry. Chris, you're muted.
Chris, you're muted. Chris? Chris, you're muted.
I appreciate that, G. And nobody will ever have the benefit of the genius that I just spoke. So I appreciate Arno and Arun. Great thought processes around constructing really well-developed indices. And you can see they have different approaches to isolating value. They have different approaches to isolating momentum, et cetera, which is cool, which is what we're going to talk about in a minute. But no matter how great any one of these sleeves or indexes is on their own, it doesn't a portfolio make, right? Like a client needs a diversified, comprehensive portfolio to have a total solution that's going to help them to reach their goals. So what you're looking at on the screen is a portfolio where we worked with Arun to create a simple portfolio that had those 3 sleeves that he just spoke about: the dividend 10, the momentum 10, and the international 10. And we put them together with some of our fixed income strategies to create a 60-40. And you can see on the screen, the risk is very similar to a 60-40, 60% Russell 3000, 40% aggregate. But what's great is that the performance is absolutely outstanding versus ACWI, which would be an appropriate benchmark for the simple reason that ACWI would be an appropriate benchmark for international, and then ACWI and AG for the model with. I'm not here to talk about performance today, but I'll just tell you that the performance of this is outstanding versus that blend of ACWI and. But I think the value as a package of what. So just in yesterday with Arno, he's like, "Oh, that's really cool, Arun, that you guys, you know, it obviously works really well, but you know." Small and mid cap. So what happens if you put them together? We have some really great modeling and portfolio. Kind of put the value momentum in with the three, both the momentum and the international. In theory, some of these are doing very similar things. They both have momentum. Third of Arun's is a between Arun strategy, Arno strategies are 0.79 and 0.0. And if you're correlations in the benefit of that is if you put sleeves together that have low correlations. So the punchline, when I put into a portfolio, just in a 25, 25, 25, the standard deviation over 22% average versus the average of, because of those correlations in the 0.7 range. What we do in having is creating different types, and they have low correlations, and so I'm finished.
Thanks, Chris. There were some technical difficulties there. You were cutting out a bit, but thank you for that. I'm going to pass it on now to Alex, who will talk about how these indices were created on the Index One platform and guide us through the process of building a factor index using the Index One platform.
Great. Thanks, G, for that. And thanks, Arno, Arun, and Chris for your presentations. Found it very, very interesting. So what we do at Index One is we support our clients in the creation of factor-based indices, among other types of indices that we build, all the way from the ideation stage to defining factors, running back tests, running live calculation, rebalancing, core production adjustments, publication of these indices. What I find really interesting at the moment in the index space overall is how advanced these factors are becoming. Even if you go back just a few years, what was called smart beta was not, in my view, that smart. It was typically based on classic sort of Fama-French 3 or 5 factor models measured in very sort of basic ways, rebalanced very infrequently. But if you look at the research and the work that's been done by, for example, Phaseinvest and Financial Trust, you have far more complexity, far more alpha, clearly from the performance. And yeah, there's just more taken into account, like regime changes or phases, and using more granular data from the financial statements or exchange data. So it does, yeah, I do like seeing this space progress at the speed it is progressing, and we're happy to be part of this as a service provider. So what our tool really does is allows for user-friendly creation of factor indices or factor strategies in relatively simple ways, but also using complex methodologies and pulling in third-party data or sort of client data, so data such as what Arun and Arno has developed to build these indices, run back tests, and maintain them over time. So yeah, and this is what I find particularly interesting is using proprietary models, proprietary data to build these indices. We help out with the basics, so around maintenance, setting the index rules about how frequently they might rebalance, managing turnover, and other factors depending on how the index is used, whether it's in a ETF or a client portfolio. We have the tools required to apply the necessary constraints and rules to make the index suitable for that. So I think, yeah, one key benefit of using our platform is our partners like Arun and Arno don't need to reinvent the wheel as it comes to gathering historical data and running the index in a live setting. We're focused on that, and they're focused on doing the factor research and building these models. So yeah, some of the screenshots you see here on the slides are from our tool. So we have quite a wide range of performance reporting capabilities, generating fact sheets, and ways of rebalancing indices and monitoring them. So that's really from my side. I think everything. I'll hand it back to G to wrap things up.
Thank you, Alex. And thank you, everyone, for your insightful contributions on factor indices and the various factors to consider when constructing these indices. To our audience, please feel free to submit any remaining questions in the chat box. We will now be answering some of your questions. So the first question we have is from Connor. Hi, Connor. What's the total expense ratio like for that example Chris was referencing? Chris, would you like to answer that?
I'm obviously having some. I was cut for. Connor, there's just a lot of different ways to access our strategies, and they're all kind of priced differently. But I can assure you they're very reasonable. We can talk offline about what kind of platform you would maybe like to use to harness it. But we can do everything from model delivery direct to the advisor to executing through tech stacks and other sorts of TAMPs. And the pricing is obviously going to vary widely depending on how it is you're accessing the IP.
Yeah, he's referring to the 60-40 model. If you'd like to, give some insight on that, Chris.
Well, absent layers of other potential costs which might be imposed by a TAMP, et cetera, 25 basis points would be a typical cost for that model.
Thank you, Chris. And we have another question from Kunal. Hi, Kunal. Can you please share two-way turnover for any of the back tests? Does anyone want to answer that?
Well, Arno doesn't have a back test. He's got 20-something years with value momentum. Hopefully he's got an answer, a ballpark answer anyway.
Sure. Since our portfolio is rebalanced on a monthly basis and we're essentially doing both rebalancing and reallocating every month. So again, reallocating is a name leaving the portfolio, a new name coming in. We're also going to rebalance all the positions back to the 2% weights. We've typically had between 20 and 30% turnover per month within the portfolio. So definitely a higher turnover type portfolio as compared to, let's say, our American Leaders Index, which is once per quarter, and there's maybe one, maybe two names coming and going. So definitely more active of an approach, hence a higher turnover.
So I just want to take a second to point out that the strategies that Arun discussed will tend to have relatively high turnover as well relative to things like the S&P 500. Obviously, a qualified account is an easy way to avoid any issues with that because transaction costs are nearly zero. But also, this is another reason why you might want to use a strategy like this in the form of a direct index, because even though you're going to develop tracking error to the underlying strategy, your ability to tax loss harvest over time can eliminate a lot of the tax drag from the high turnover, which is a great thing about owning the securities directly. And some of our clients who really want to get into the weeds, we can work with you to provide like substitute positions for the names that you're tax loss harvesting that are going to keep your tracking error as low as possible while minimizing, or at least significantly reducing your tax burden. So, go ahead, Arun.
No, I just wanted to say that, for example, we do have a size portfolio as well, which is based on market cap, right? So to compare against the general market index, which is a market cap base, then that would be a good example because a size attribute doesn't change that much, right? A large company remains the same. A more alpha type factor strategy like momentum and value will have turnover because the scores change, the attributes of the stocks change, and we must change along with them. Otherwise, then if we are just looking to keep it static, then we might as well just invest in a market cap base. So after costs of transacting and changing, they still deliver a significant uptick. So, but there's a size-based index that is very low turnover.
Perfect. Thank you so much. Just one last question, if anybody would like to answer this. How do you ensure that factors like size and quality don't overlap excessively, which may lead to overexposure to certain stocks?
Sure. I mean, I can answer that. When it comes to the size factor and quality, they're not mutually exclusive, unfortunately. Just because it's a large company does not mean it's quality oriented. So the overlap between those two, depending on what type of portfolio and how you combine them together, is not really significant. In our case, where we're running, our value momentum leaders strategy, our quality factor is very limited as compared to our smart beta strategy, where there's 5 different factors in our profitability and quality factor. Within value momentum leaders, it's just higher year-over-year earnings to try to show quality. So not a lot of overlap with there. It's really just for us, the quality and higher year-over-year earnings is really to find companies that have the wind in their sails, essentially.
Yeah, and as I mentioned, what we do is we do control the size exposure of the portfolio, in an active basis. So we want the overall index size, the weight, the weighted exposure of size to be very close to that of the universe. And once we control size, based on the construction methodology, as I discussed, where we target the factor in question, we find that our indices are pretty much neutral to every other factor. Now, of course, there are factors that, for example, a dividend yield and growth strategy is a special case of a value strategy. So that index will have a slightly higher value exposure than the universe, but it will be neutral to momentum and low volatility, etc. And conversely, a momentum portfolio, because momentum is the other side of the coin of low vol, it may have a slightly higher vol, but it's pretty close to the index. So controlling size helps us control exposure to unintended exposures to other factors, and we can share some exposure information if you like.
Brilliant. Thank you so much. And thank you to everyone who asked a question. If you would like to get in touch with any of today's speakers, you can reach Alex at index1.io, Arno at financialtrust.net, Arun Soni at Phaseinvest on LinkedIn, and Chris at bxindex.com. You can find Financial Trust and Phaseinvest's models on the Index One and BX websites. Thank you all once again for your time and participation, and we look forward to seeing you at our next webinar. Thank you, everyone.
Thank you.
Thank you.
Thanks, G.